Good afternoon, everybody. I'm sorry I'm not with you in hot climate. I'm stuck in London, unfortunately, but hopefully next year I'll be able to get away. Anyway, this presentation is discussing property market risk and liquidity within UK property funds through times of market stress, i.e. a crisis, such as the GFC or the Brexit referendum. So we're going to look at the background to the study. We're going to discuss the purpose as to why we did the study. We'll look at the data that we analysed, the methodology by which we analysed that data. Clearly, we're looking at property cycles and the volatility analysis of capital values during that time period. But we're paying specific attention to two case studies, the GFC and Brexit referendum, and we're looking at liquidity trades that could be performed during that time period. And at the end we'll wrap up with a summary before moving on to next steps from the paper. Okay, so twice in the last decade UK property funds have endured extreme market shocks leading to sharp drops in valuations, and the ramifications of that have led to redemptions and in some cases gating of funds. Now, the two incidences we're going to focus on is the global financial crisis 2007 to 2009 and the Brexit referendum, which was even more acute, which happened in end of June 2016. So as a result, there's been increasing market and regulatory attention paid to how UK property fund managers can better manage the liquidity risk of their funds at times of extreme market dislocation. And this is coming both from the regulators and indeed from the investors who were concerned during these time periods. In the UK, there are a number of different tradable near cash property instruments that can be used for liquidity management, such as listed real estate, i.e. REITs, property futures, which are derivatives, and then secondary funds, debt, and cash. We'll show how some of these instruments can be used to manage liquidity risk, whilst at the same time reduce volatility and increase the overall returns of the fund using portfolio overlay strategies, as used in equity and bond portfolio management. This is the first in a series of studies looking at improving liquidity within UK property funds. The paper focuses on the Lehman Brothers collapse and the Brexit referendum and the impacts that these two events had on the UK commercial real estate market. We will show that liquidity risk and market risk are inextricably linked, and that to access liquidity in real estate when it is most needed, fund managers need to be managing market risk through the cycle. They can't just turn it on like a tap as and when they need it. It has to be something they consider throughout their investment process. By disaggregating the risk and return profiles of direct property relative to the risk return profiles of property derivatives and REITs, we'll demonstrate how a UK property fund manager can improve liquidity within their fund, solve the daily price, daily tradable conundrum for DC funds and discretionary fund managers, improve the risk-adjusted returns performance of their fund, mitigate known and unknown market shocks, offset investor concerns around the ability for a fund to effectively manage redemptions, trade the relative value gap, preserve investor capital, and outperform the market. A couple of caveats. Normal issues surrounding backtesting and assuming ex post results will hold true going forward. Current CRE funds are constrained by mandates. They're not allowed to hedge and they're not allowed to use a blended approach. And they do not possess trading skill sets within their organization. And this is possibly the biggest limitation factor as to why these trading strategies aren't currently being used within the real estate industry. Finally, the liquidity enhancing trading solutions imply increased trading, but use cheap to trade instruments, and that's relative to trading bricks and mortar assets, i.e. buildings. So the data we use is the MSCI-IPD All Property Capital Return Index, the Arca PRM pricing for property futures, and the EPRA UK index for REIT returns. We look at the data monthly. The currency used is GBP sterling, and as specified, we use MSCI and P Scott's data preceding the MSCI time series. But we're focusing specifically on the periods 2006 to 2009, that being the global financial crisis, and the Brexit referendum in June 2016, and of course the aftermath of that leading into 2017. So the key metrics used were the UK CRE time series data 1947 to 2017, and the specific analysis around the two case studies, the global financial crisis and the Brexit referendum. We established pricing and trading returns across direct property, property futures and REITs during these time periods. We established correlations and lead lag of liquid real estate versus the direct real estate. And we identify trading strategies that use short-term near cash property instruments to provide greater liquidity. And we combine strategies to determine optimum outcome for adding near cash liquid real estate products to a direct portfolio. Okay, so if we look at property cycles in the UK CRE market since 1947, we can see some distinctive patterns. That being that we have a period of 15 odd years in a bull run leading up to a market peak, followed by a deep and pronounced trough. And we can see these occurring at several stages in history during the cycle. If you overlay the capital returns onto that chart, you can see that effectively they have a very high correlation to the total returns, and the difference being obviously the income returns, which are relatively static in terms of volatility. If we discuss that theme a bit further and look at the volatility of the income returns, you can see over that time period it had a minimum return of 4% with a maximum of 8.9%. So those being the sort of two outliers, if you like, but the mean average was 5.94%, roughly 6%, and it had a standard deviation, i.e. a volatility metric of nearly 1%. So that means with each year passing, you'd expect a difference of 1% plus or minus on the 6% mean. If we relate that to the capital returns, we can see that there's a mean of 4% with outliers, a minimum and a maximum of minus 26.3% and 23.6%. So a much wider disparity of returns as you'd expect around capital, and that is expressed with through the standard deviation of being 9.31%, so nearly full 10% standard deviation, showing that from that mean you could be either plus nearly 14% one year or minus sort of 6% the following year. So obviously during a cycle it's a bit more predictive than that, and volatility tends to come in short, sharp doses, but this gives you a relatively good indicator of how volatile real estate can be. So really during the property cycle, as we can see, you've got these periods of slow upwards incremental growth periods followed by these short, sharp, rapid declines. Now, the important thing to remember here is you can trade risk on and risk off using short-dated near cash property instruments a lot easier than you can by buying or selling a property. So The point here is it's very obvious when the cycle is reaching its peak. It's not very obvious when it's going to turn, but one can always know when the market is getting toppy by relative or historical terms. So at that point, you would apply a risk-off trading strategy using these products. Okay, so taking the global financial crisis as a case study, there are two liquidity trades I want to show that could have helped a fund manager going into the crisis and also during the crisis. So traditionally, there's an inevitability once the market turns that a property fund manager can't do anything. He's just got to batten down the hatches and wait till the crisis passes. He's holding all this real estate and it's very difficult to trade in and out of the market. That's why derivative products are so useful. They're easy to trade, they're quick to trade. And if you look at the IPD capital returns month on month going into the crisis, they were very high. You were having a strong return, 2% per month, and these were at or near record returns on an already inflated market. So it was obvious that the market was at a peak. What wasn't obvious was when it was going to turn down. However, one should have started to take precautionary measures by hedging the market using derivatives, and particularly the futures, which, as you can see, once the market did start to turn down, pricing became very attractive very quickly, and had one sold this in this way, one would have protected their portfolio as the market continued to trend downwards. And that would have been a very good trade. If the market lost, say, 15%, you would have gained 15%. So it would have been a very nice way to protect yourself from a downturn in the market. And likewise, as the market was becoming more and more depressed, instead of trying to call the market, it was a question of trading relative value, i.e. buying something that's cheap in real estate and selling something that's expensive. And one could have used the difference between REITs and futures prices to do that type of trade. So to sell futures as they were expensive and buy REITs as they were cheap, and then lock in that value gap. Okay, so moving on to the second case study, Brexit, which is a great example of a known potential market shock. The trade to have done here would have been to done a market risk neutral trade prior to the referendum. By that I mean buy one particular segment, say all industrial, and sell all retail, for instance. So you're long one segment, short another, and essentially you're market risk neutral. So if the market suddenly shot up after Brexit, you would have been covered, and if it shot down, as indeed it did, you would have also been covered because one of your legs you had sold, so you were hedged. So that would give you good risk-adjusted returns and protect you from any market shocks or falls. The second sort of trade might have been to do a risk-on trade once the market collapsed, to realize that actually this wasn't a sustained collapse, but actually just a market reaction that was made worse because of the illiquidity in real estate, and that when the market was pricing down at -15 immediately after the referendum, that was the time to buy back in, or certainly 3, 4, 5 weeks later, once the immediate aftermath had sunk in and pricing had come back maybe to -10, there was still a huge buying opportunity, given that at the end of the year pricing finished in positive territory for the UK or property total return, although that including income, although capital values in the event only fell 2% for that year. So there were two very good trades, and this slide basically shows you the bid-offer spread immediately after the Brexit announcement. Here's the bid, i.e. where people were willing to buy going towards the end of the year, and the offer where people were willing to sell. Now clearly there was a bit of discrepancy there, but once it was obvious where market values were going at the Q3 IPD MSCI number, we actually executed 3 trades there, given the certainty of return to the market. But the interesting thing is, if we overlay REIT returns during that same period, you can see that they were a lot more volatile and they sank a lot lower than the futures prices, and that's because REITs are part equity and because there was a lot of people saw that as the easiest way to get out of UK real estate, by selling REITs. But even as the year progressed, you can see that REITs didn't recover as much as the property market as measured by MSCI-IPD did, and that reflects the greater risk that generally the big UK REITs hold, that being that they are retail and finance or office focus or concentrated, and they obviously hold equity market risk as well as the debt in their buildings as a real estate investment. So bringing it all together, looking at the last 2 major market disruptions in the UK, it can be seen that liquid real estate instruments do have a significant role to play in mitigating risk and improving performance, but only if they're used properly. And this involves employing short-term trading strategies, using near-cash property instruments, trading at the top-down, i.e. portfolio level, as opposed to the asset-specific level. And one's got to be able, in their mandate, to be able to hedge and go short, as well as buy exposure quickly at opportune moments. And you've got to use pricing indicators from various sources to spot relative value and then trade on those indicators. Okay, to summarize quickly, I've listed the problems on the left-hand side with solutions on the right-hand side. So to improve liquidity in funds, you want to trade short-term near-cash property instruments. To improve your risk-adjusted returns, you want to trade market risk neutral strategies at key specific moments, and by that you do sector or segment switches. To mitigate the risk of specific known or unknown market shocks, you'd use risk on, risk off trades. To offset concerns surrounding future redemptions, you demonstrate various liquidity buckets to your investor and allow them to choose which one they wanted to invest in. To trade the relative value gap, you're just essentially buying something in real estate that's cheap and then selling conversely something that's expensive relative to where you're at right now in the market. To preserve investor capital, you'd want to hedge, and to get outperformance, you'd want to sort of influence the present but not the future. It's not crystal ball gazing, it's just investing using all the information you have at your disposal. So in terms of next steps with the paper, we want to do some more analysis around risk-adjusted returns using Sharpe ratios. We want to look at liquidity further in terms of maximum drawdown, depth of the market, and quantifying execution risk. And we want to undertake similar analysis looking at other products, namely secondary funds, debt funds, and cash. So thank you very much for your time. I hope this has been useful. Once again, I'm sorry I couldn't be there, but if you have any questions, please feel free to email me at costrmoff@arca.com, and hopefully I'll see many of you next year. Thank you. Bye-bye.